Gold, why is it down the least of all these asset categories when the Fed has claimed they're fighting, quote, inflation? Well, we think they're fighting inflation, but the inflation that they're bursting is the stock market inflated bubble, the bubble they created, and they just stuck a huge pin in it. And there should be no shock on the part of those who observe central banks to recognize that that's what's going on. Their policy has broken inflation, which went into the inflated money supply, went into the stock market for a dozen years. It did not go into commodities. Commodities laid on the street corner. Look at the Bloomberg Commodity Index, for example, back in 2008, 2011, it was well up in the 200s. It collapsed down into the high 50s. 50, okay. In 2016 through 2020, and it laid there for 4 years. Nobody cared about it. Prices of most commodities were at levels that were just ridiculously, theoretical zero levels, really. But all the money that the Fed created went into the stock market instead of the commodity markets. But in October of 2020, at that point, the Bloomberg had rallied up to about 70, 15 points off of its bare low. We said there's a commodity explosion coming. This is October 2020. Putin didn't invade Ukraine until February, so it wasn't Putin that caused this explosion in commodities. And virtually every commodity you could throw a dart at, energy, grains, copper, you name it, all of them exploded during that time. Gold had already exploded. In fact, it had peaked in the summer of 2020 after having been at 1,050 in 2015. At its bare low, it reached 2,070 in mid-summer of 2020. So it was well ahead of the commodity explosion. They were still in the sewer when gold was making its high. But the commodities joined in. And this, of course, upset the Fed because they call inflation, when it's commodities, not when it's stock prices. That's okay. But when the corn price goes up, I can't put up with that, or gasoline prices. So they came in with their pitchforks and think they're going to bust the bubble. Well, they did, okay? And I hope they enjoy it. Once you bust a bubble like that, you can throw all the money you want at it. The problem with it is in the past, whenever a bubble has burst for them, like the dot-com bubble, which late in that bull market, they did in fact sponsor because there was a monetary crisis in late 1998. And the central banks just went berserk to protect against it by printing. And that helped boost that bubble. But once these bubbles break, the central banks come in and they try to stop it, with rate cuts or whatever. Like 2008, they came in buying mortgage-backed securities. That didn't stop the collapse in that market, by the way. In fact, it exacerbated it. So when bubbles break, they won't be able to stop it. Why? Because asset managers and wise investors say, hey, I've had enough of this one. This market is nothing but high risk, low reward possibilities and high risk. I'm gonna move more money over to somewhere else. Well, as I explained, there's nowhere else to go other than perhaps gold, which is down the least. In fact, if you ran nothing but a gold bullion fund, you're beating the pants off all your competitors in the portfolio. So when the asset managers make that kind of decision, and I'm talking about non-gold bug asset managers, Ray Dalio's of the world, they've spoken out about this issue. Ray Dalio's quote, I think it was like a year ago, said, quit focusing on the price of your stock. Instead, pay attention to the underlying degradation, underlying value of your money unit. So he's keenly aware of what's really going on. And it's guys like him that make a shift like this. And once they make that kind of shift, they don't just flip back 2 weeks later. They're making a judgment call of an investment grade quality. And there's lots of guys like him now who've made that decision that I'm out of this, or I'm shifting more out of this and into something else. And commodities is one of those arenas. And gold, I think, is about to be resurrected again and to continue the bull trend that's already underway that began from the 2015 low. But the effort to break commodities, right now we're getting a pullback in commodities. Bloomberg Commodity Index, for example, which is a well-balanced index, not just heavily energy. It has had a correction, or in fact, oil has pulled back. It hit a high of 130 and it's traded into the 70s recently. We think it is a corrective downside move in commodities that we've been witnessing for the last several months. It is not the end of the commodity upside. It's highly likely we've only seen the first major upwave in commodities. Once this correction process is over, expect commodities to engage in another upleg. And we do expect it to occur, and it will not be just focused on energy of that sort. It'll be, I think food commodities are likely to be a headline type event. We think that's what's going on, and we think the paper asset bubble is breaking. It will continue to break over the next year or two, probably in some serious in-the-street type of repercussions. The everyday guy is going to feel it, not just the guy who owns the portfolio. This is going to influence the central banks to do what they do best, which is to print print. It's an interesting world, and we think it's going to be quite violent, and we think the major benefactor is going to be monetary metals because the central banks cannot play the game they're playing now. They'll have to revert back. They were founded for the purpose of funding government debt markets when they're unfundable otherwise. And I think that's a situation we're facing soon. And therefore, where do you go? And I think some of the evidence of where asset managers are going isn't that gold is going up, though I think that's going to occur. I think it's going to resume its ongoing bull trend. It's that it's not going down like they are. How come? And I think the reason is that we're coming to a monetary crisis and a government bond crisis. We're seeing the beginnings of it. And there's only one alternative for central banks at that point. They have to defend. And I think gold knows that that's around the corner. So what you don't want to do, if you're bullish on the dollar, you better have your stop in place. In fact, it wouldn't shock me to see the dollar go into the bin again, big time. To beat your chest about the strong dollar is really sort of ridiculous. I mean, you're dealing with one piece of fiat paper versus another piece of unbacked fiat paper. So, it's hard to see value in any of them lasting anyway. But that drop in the dollar, a top in the dollar now, will impact gold, I think, greatly because it has been inversely correlated recently, especially. And I think that correlation, that inverse correlation will continue. And I think gold will get a benefit from that. But silver will get more. As far as silver, ultimately, go back and look at gold from the early 70s to the present, so 50 years. There have been three major bull markets in gold, each of which produced either a 7-fold increase in price from bear market low to bull market peak, or an 8-fold move. Take, for example, the 1976 low just above 100. By 1980, it was 850. In 1999, early 2000, gold was at $250 an ounce, just above there, making a low. It went to 1920 with their 8-fold move. So it's had three moves. In the early 1970s, it was at $30 and went to 200. 1975. Okay, that was almost a 7-fold. So you've had three moves of that dimension in that 50-year period. So it's not like it's some rarity to say every 10, 15 years it generates an 8-fold. Okay. Well, we certainly have the preconditions now for a monetary crisis. Therefore, a situation in which the world turns to a backed currency, turns to gold again. Who knows who will lead that? Maybe the Chinese will. I don't know. Somebody will come up with a gold-backed currency and the world will flock to it. But if gold merely had another 8-fold move, it would be $8,000 because its bear market low is 1,050, 2015. Is that extraordinary? No, we've done it 3 times in the past 50 years. And the current conditions certainly could justify another one, right? Okay. If silver were merely 2% of the price of gold and it were $8,000, well, you do the math. It's off the page. And 2% is a level that silver has seen so many years in the last 50 that it's the majority of years silver's at least seen itself at 2.1%. It's routinely seen that level as a minimum. So when we talk extraordinary numbers like that, it's not so crazy, even when you just look at a price chart. Gold's done it 3 times. It could do it a 4th time. Certainly has the justification for it. And silver just coattailing it and going to a normal ratio would be off the page.